Hello, everyone. Thank you for joining us for this special session on breakout stocks. Those are stocks that are showing patterns on the chart, indicating that they are about to break out, to blow up, to have some serious price action. Uh, Today, joining me, as you can see, is Gianni Di Poce. We'll get started in just a few minutes. While we're doing this, while we're waiting for folks to trickle in, I want to make sure that we get everybody in here so we don't miss anything from the beginning. While we're waiting for that, why don't you guys drop in the chat? Let me know your name and let me know where you're from. We've got about 5,000 people registered for this. We're also streaming live on YouTube. So a big hello to YouTube. Hi, YouTube. If you're on YouTube, make sure to hit that subscribe button and also make sure to hit that bell so you can get a notification next time we do one of these impromptu education sessions. So yeah, guys, you guys are going so quickly in chat. There's no way I can keep up with you. But I see Colorado, Hawaii, Florida, Raj, Barry. Hey, Dan, how's it going? Antarctica, Ron, I believe you are. Um, so like I said, I want to give you guys a few minutes just to get in. I don't want to give away too much stuff before everyone's in here to see it. So just keep giving me your name. Let me know where you're from. Um, and if you're on YouTube, make sure to smash that subscribe button and hit the bell so you get notifications for future surprise sessions like this. Be back in a few minutes. Hello, everyone. Welcome, welcome, welcome. Happy Sunday to you all. I'm Neil Hamilton with Benzinga, and it is my great pleasure to be with you today. Boy, oh boy, has there been quite a turnout. We have so many people that have come into our Zoom webinar. We're about to hit our 1,000 person cap that we have turned on our YouTube live stream. So so if you're here, you're lucky. If you're in Zoom, you're lucky. If you're on YouTube, you're also lucky because you're going to get some great content. I'm going to do the best I can to keep up with you in chat, but Zoom's going to get priority. At any rate, let me introduce to you my friend and colleague, Gianni Di Poce. Gianni, why don't you tell our audience today a little bit about yourself and what they're going to learn over the next 40 minutes to an hour?
Sure, Neil. Thank you. I'm very excited to be here, everyone. My name is Gianni Di Poce. I've been trading now for about 9 years. The first 5 to 6 years of my finance career, I spent in the financial advisory world, where I was the main trader for a $250 million portfolio during that time. I worked pretty closely with various institutions, your Fidelities, your Vanguards, your Schwabs. And so we kind of learned the inside ropes during that time, and incorporated some of those institutional techniques into my own through trial and error. And now here we are today. So we're going to look how to buy stocks that are on the precipice of breaking out to maximize our rewards while minimizing our risk.
Beautifully said. So, guys, that should answer your question. What is a breakout stock? What is a breakout stock? And with that definition of what you guys are about to learn, okay, looks like Steven, you got no sound. Hey guys, in the Zoom chat and on YouTube, if you have sound, can you just give me a 1? If you have no sound, can you give me a 2? Okay, it looks like most people have sound. If you have sound issues, you might want to look at your computer settings. All right, Johnny, with that, I'm going to stop sharing this little splash screen and let you take over. Does that sound good?
Sounds great.
All right, man.
I'll go ahead and share my screen. All right, Neil, can you see my screen?
Yes.
We're
good to go.
Let me get the PowerPoint set up here. Okay, so welcome to the Benzinga Breakout series on how to buy breakout stocks. Okay, so like I mentioned, all about breakouts. The main concept we want to start with here is that we want to maximize our returns while minimizing our risk. So what are some of the tools and concepts that we use in order to find and successfully speculate on breakout stocks? So the number one tool that we use is technical analysis. And we do this in order to spot opportunities ahead of time, right? So history does not repeat, but it rhymes. And the best predictor of the future is the past. And not only do we use technical analysis to spot opportunities ahead of time, but we do it to manage risk. Because as traders, we need to be professional risk managers, okay? If you approach trading like a business, okay, you have to understand that there will always be losses. You don't need to have a 100% success rate on your trades to be a profitable trader. In fact, if you manage your risk properly, you can afford to be right in some instances just 1 out of 4 times and still come out ahead. So again, if we approach trading like a business, every business has expenses, okay? And so you have to view your losses as a trader as a business expense. So it's unavoidable. And the key is to maximize your returns, cutting your losses short while letting your profits run. And technical analysis is our number one tool that we use to achieve this goal. Okay. And another principle that we have with respect to technical analysis is the notion that sentiment follows price, not the other way around. So last year, it's crazy how time has flown this quickly, but last year in March 2020, we had the Corona crash. Go back and look at some of the articles about the stock market at the time, and the world was ending, okay? And that turned out to be the bottom. So the price move had already happened, and the sentiment was a lagging indicator, okay? And so now, what type of environment are we in at the moment? I would say that we're in a more euphoric, manic environment. Now, I still think that stocks make new highs this year, but we could see some volatility in the short term, and we'll talk about that a little bit more in the upcoming slides. And the last principle that I want to mention with respect to technical analysis is the notion that there is a natural order to our world, okay? There are no coincidences in nature. I'm an urban farmer as well. When the season's warm, I'm here in Michigan, so it's pretty chilly and snowing a little bit right now. But, there are no coincidences in nature, and there are no coincidences in the market. Humans are extensions of nature, regardless of how, separated we might be from it these days, but we're still subject to those same natural laws. The law of nature is cycles, and markets move in cycles. They are not linear. They are inherently cyclical, okay? So what we're going to do now is we're going to start off by looking at some of the best chart patterns that I like to use to identify stocks that are about to break out. And the good news about these chart patterns that I'm about to share is that they work the same across all different markets. So it doesn't matter if you're trading stocks, Forex, cryptocurrencies, futures. I myself, I trade equities and I trade futures. But, for the purpose of what we're going to look at today, we're going to look at equities, and I'll throw in an example of a cryptocurrency later on at the end when we're talking about how to actually identify a breakout. So there are two types of patterns that we want to focus on. There are more categories in terms of price patterns than these two, but for the purpose of identifying breakouts, we want to focus on continuation patterns and momentum patterns. Now, like I said, there are other ones too, stuff like reversal patterns, but that's a little bit beyond the scope of this topic here today, where we want to focus on breakout stocks. So let's identify some of the continuation patterns that we like to use the most. The first one, or I should say the first three, all part of the triangle family. The first one is the ascending triangle. The second is the descending triangle. The third is the symmetrical triangle. And then we have the rectangle. And then we have the ascending and descending price channels. Okay. Next, we have the momentum patterns. And so we're going to focus a little bit more on the momentum ones here today. I'll show a couple examples of the continuation ones as well. But the momentum patterns, these are our real bread and butter price patterns. So we have the saucer patterns, the broadening wedge, which is one of my favorites, probably because not too many traders seem to use it. And it's one of those things where, you know, the more that people use it, it doesn't work as well. So I really like the broadening wedge. And then we have the cup and handle pattern, made famous by renowned trader and founder of Investors Business Daily, William J. O'Neill. Highly recommend you check out his work too. And then we have the bull flag, which is one of the fastest and most powerful technical patterns in trading. So that's another really good one that you definitely want to have in your back pocket. And then the rectangle. Okay, so let's take a look at an example of a saucer pattern. So the examples I'm going to share with you today are actually real trades that we put out to subscribers to the Benzinga Breakout series. So this one is an example of a saucer pattern, and this is Upwork stock. Okay, so you may recall this was a hot stock early in the summer, and we identified a saucer pattern for subscribers sometime in it was late September, early October. So a saucer pattern is characterized by an upper horizontal trend line and then a lower U-shaped parabola. So a trend line by definition is when prices touch or are rejected by a certain level of price. So here, let's look here. Upwork touched this upper horizontal trend line 1, 2, and 3 times. The buy point, once you identify a saucer pattern, is on a close above the upper horizontal trend line. So you notice I just said close. Why close? Well, if a stock moves above a level of resistance, but then closes back below, it can turn into a case of a false breakout. Okay. And from false moves come fast moves. So you can get whipsawed out of a position if you get in too early. I like to trade at the end of the day, especially when I'm trading equities. And, you know, I mentioned at the beginning that I spent some time in the financial industry, and I worked pretty closely with the institutions. And there's a saying that's circulated among traders that goes, you know, rookies trade the open, pros trade the close. So a lot of the big institutions, a lot of the big dogs that have the deep pockets that are actually able to move the price of a security tend to trade at the end of the day. And if you don't believe me, go and look at an intraday chart of any stock, and you'll notice that there's a spike of trading activity or volume at the open or at the beginning of the day, and then at the close. Because at the end of the day, that's when all the algorithms and all the trading programs are triggering, right? So if they have a rule that says, hey, we want to buy when stocks are, 5% above their 20-day moving average, for example. I'm just throwing that out there as an example. That can only be achieved upon a closing price because that is the final point of data. So it's important to have rules and principles when you want to trade. So we flashed a buy signal on Upwork. Let's see, this was around $15, $16 a share, give or take. And then it ripped higher. We ended up having like a 60-some% gain in as little as 2 months. So you'll notice here that I issued a sell signal for subscribers in November. And you're like, well, Gianni, why are you showing us this? Because, we continued on higher. Well, I mean, look at the opportunity cost. We might have rallied an additional, 15% or so off that, but there are better opportunities out there sometimes. And you'll see some examples where, we made some sales later on and the stock ends up being at the same point, 2 to 3 months later down the road. And again, if a stock is not paying you while you're holding it, you're missing out on other opportunities. You don't want to tie up your capital in a trade that isn't performing. Again, opportunity cost. Time is more important than money. Time is more important than price, especially when it comes to trading. Okay. So let's look at another example. Fubo TV. This was a really hot stock, really caught the headlines of a lot of traders. We identified a saucer pattern, again, characterized by an upper horizontal trend line, whereby prices are rejected multiple times. So let's see. Here, prices were around the $12.20 range. We were rejected 1, 2, 3 times. And then once again, we had the lower U-shaped parabola that is characterized, another characteristic of a saucer pattern. So the buy point that we issued was on a close above 1220. That was achieved in mid-October. And as soon as we closed above that, this stock started to move pretty quickly. And we ended up coming up with just short of a 200% gain. So we pretty much almost tripled our money in, what was that, like 2 months. So this was a big winner for subscribers to the Benzinga Breakout series. Now look here, once again, we sold out just before the peak. But again, are we going to cry over spilt milk? This is a daily chart. So we sold out 2 days before the high. But then look what happened. I mean, sometimes when a stock is this explosive, you can get caught up in your emotions, and you're not going to sell the top every time, just as you're not going to buy the bottom every time, but you don't need to. There's plenty of meat in between of this price move to make a good living. All right. So at the end of the day, are we really going to fret about a 250% gain instead of a 300% gain? I mean, I'm probably not going to, and I'm going to take those gains and try and compound them elsewhere. So this is another example of a saucer pattern that we identified, and it turned into a very profitable trade for our subscribers. Here's another example of a chart pattern that we like to use. I mentioned how it's one of my favorites. It's the broadening wedge pattern. Okay, so the upper horizontal trend line, once again, we have it on this price pattern, and we see how prices were rejected. Okay, this is a level of resistance. Resistance is when prices are rejected at a certain level. Okay, whereas support is when prices are rejected at a certain level where prices are declining. And a good principle to take away from support and resistance is that when resistance breaks, it becomes support. When support breaks, it becomes resistance. Now that example isn't really showed on this one, because once we broke above resistance as characterized by the upper horizontal trend line, CARE-DX just broke out and never looked back. So the broadening wedge, once again, upper horizontal trend line, but then we have a downward sloping lower trend line. Okay, so the buy point is on a close above resistance or the upper horizontal trend line, and we identified this for subscribers. This was back in July, August of 2020, and we ended up coming away with a 60% or so gain. Now this is one of those where we sold out a little bit too early, but again, I'm not going to be upset over a 60% gain in less than 2 months. So that was an example of a broadening wedge. Let's take take a look at another example. This was Chegg. Okay, we identified this price pattern back in, let's see, it was May of 2020. So what happened was, I remember this vividly, and it was pretty frustrating, but sometimes you just have to let stocks go. And what happened was, is we had identified a buy point on Chegg on a close above, it was like 40 some dollars, but the exact buy point escapes me at the moment. But what happened is that Chegg had a really good earnings report, and our buy point was not triggered by a matter of like 5 to 10 cents. So what happened is that the stock gapped up and rallied about 30% in the pre-market, and we missed the entry point. But I sent out an update to subscribers, and I told them, I said, hey, we missed the entry point. Let's not chase, because remember, our number one job is to manage risk as traders. So I said, let's buy it on a price retracement. So I used the Fibonacci retracement, which we're not going to talk about today, but we do use this in our analysis. And I think we ended up getting this on a 38.2% Fibonacci retracement. We pretty much bought the low of the retracement, and we ended up coming away with a pretty nice gain. So Now look at where we sold here. Okay, so we ended up buying on the retracement back in May, June of 2020, and we sold out in July 2020. And prices pretty much were range bound for about 5 to 6 months. So had we held on to Chegg, you know, that would have been dead money. Yeah, we have a gain, that's nice, but you know, it all comes down to what are your goals with trading? Are you looking to compound your money in the short term, or are you looking to buy and hold? Now, yeah, again, you know, we rallied to new highs, but now we have a case of bearish divergence in price from the RSI indicator. We're not going to talk about the RSI much today, but this is a momentum indicator or a technical indicator that serves to measure momentum of a particular stock. And momentum is confirmed when we see new highs made in this momentum indicator in conjunction with price. So you can see how now, you know, this past week, Chegg did make a new high, but it looks like upside momentum is running a bit short. So I probably wouldn't be chasing here. You know, I'd like to see this stock maybe digest its recent gains a little more before finding a more favorable risk reward entry point. But nonetheless, it stays on our radar. Let me see, can I? Okay, I'm trying to get this lower part of the screen to go down, but that's okay. Because I wanted to show you guys some examples of the volume, but no problem. In any case, the next price pattern.
We can see the volume, Gianni.
Oh, you can see it? Okay, so it's just blocked off on my screen because of the zoom bar. No problem at all. Okay, thanks, Neil. Yep. So the next pattern we want to look at is the cup and handle. Okay, so this stock is Fulgent Genetics. All right, and we identified a cup and handle. So you'll notice another similarity between this price pattern and the previous ones that we identified. Once again, we have an upper horizontal trend line, okay, as characterized as resistance. So we rejected this, prices were rejected by this level of resistance 1, 2, 3, and maybe even 4 times, right around the $48 zone, okay? But a cup and handle is characterized by 2 parabola-shaped cup and a handle, I guess is what you would call it. But there's 2 U-shaped, you know, patterns that are identifiable that are part of the cup and handle. And, you know, one of the things that is characterized by this pattern, and most breakout patterns for that matter, is a compression of volatility that occurs before an expansion of volatility. So volatility doesn't always need to be to the downside. It can be to the upside as well. And this is just a very straightforward principle of physics, right? So, you know, again, I said things move, markets move in cycles, just like nature does, right? We have seasons to the year, and, you know, there are seasons to stocks as well. And those seasons can be characterized as periods of volatility. So, you know, markets are not linear, and neither are stocks. So we issued a buy alert for subscribers on a close above the upper horizontal trend line in June, and we ripped above that price point, came out with about a 50 to 60% gain on this. Actually, no, it's more than that. It's about a 60 to 70% gain. But we just issued a.
Don't sell it short. Don't sell it short, Gianni.
Yeah.
I wanted to mention really quick. So a lot of folks, we always get this question when Gianni is showing charts. Is which time increment or which time chart are you looking at? Would you mind, Gianni, just as you go through these, just let folks know if you're looking at the daily, the weekly, and so forth?
Of course, yeah. So that's a great question, and thank you to the viewers that bring that up. I do tend to forget that, but that's okay. So in this particular case, this is a daily chart, right? But I do like to see price patterns across the weekly and daily time frames. And, you know, I don't know if I mentioned this already, but, you know, the trend is your friend. And a good rule of thumb is that the longer the trend, the more powerful it is. So, you know, there can be instances whereby you identify an uptrend in a weekly chart, but, you know, on the daily chart, a stock's in a downtrend. But like I said, the longer term trends tend to overpower the short term ones. The best case scenario that we see is when we see uptrends on the weekly and the daily chart, but even better when we see it on the monthly chart. So again, the longer term trends tend to overpower the short term ones. And yeah, so that's that. Now, another thing I want to point out here is take a look at the massive signs of accumulation. I'll touch on this in further slides, but you know, we like to see evidence of accumulation, and I'll tell you how we identify that later on. But we want to see more buyers than sellers, especially when we're looking to buy a breakout stock. And, I mentioned earlier, it's the institutions that have the buying power to actually move the price of a security. So we have an advantage as individual traders and investors in this regard, because the fact of the matter is, unless you're trading, with hundreds of millions or billions of dollars, you really don't have the buying power to move the price of a stock. The exception is, you're trading penny stocks, but, we're not talking about that here today. But to use a military analogy, we're kind of like the undercover assassins, whereas the mutual funds and the institutional funds are like the heavy artillery, and they have the ability to shake up the price of a security. We have the ability as individual traders and investors to enter and exit our positions under the radar. So, even if you're trading 100 shares of Apple, that's a few $1,000s. You're hardly a blip on the radar. You're not going to change the trajectory of the stock. So that's an advantage in that respect. Okay, let's look at another example of a chart here. This is alarm.com holdings. This is a daily chart. We identified another cup and handle here. So once again, we see an upper horizontal trend line characterizing resistance. We see that prices were rejected by this level 1, 2, 3 times. And, once again, we want to buy on a close above the upper horizontal trend line. And so the second part of the cup and handle is the two U-shaped or parabola-shaped lines, right? So we have the cup and the handle. We buy in the close above the upper horizontal trend line. This was also an alert that we sent out to subscribers, and we actually just sold out of this particular stock on Friday. I'm not going to lie to you. I think there's increasing evidence that stocks right now are showing signs of risk off. That doesn't mean that the bull market is over. We're nowhere near that, in my opinion. But, again, stocks move up and down. And what I want to see if we do pull back here is a significant higher low. And I think we will see that. But, there are various indicators that are suggesting in the short term that, we probably should be a little more conscientious of our risk management at the moment. So, again, this was an example of a cup and handle. We just sold out on this. We ended up coming away with it was like a 36 to 40% gain on this alarm.com chart, which again is a daily chart, an example of that. Okay, let's look at a bull flag. So we're going to go all the way back on this daily chart of Spotify to June of 2020. Okay, so a bull flag is characterized by two parts. We have the establishment of a flagpole, right? So again, there's a period of low volatility, and then volatility expands. We see the establishment of a flagpole. So we'll see a high, tight flag. And then again, I said volatility compresses after it expands. We call this afterwards flagging. So it's kind of an example of a rectangle too, but we see that prices flag. And notice that this flagging only lasted about 4 to 5 weeks. And so bull flags are really fast patterns. When you identify them, especially on the daily chart, chances are you're going to be on the precipice of a opportunity to make big gains in a short amount of time. So we issued a buy alert for subscribers on Spotify back in June. Came away with a 40-some% gain basically in 2 weeks. So that's really, really nice. Now we sold here. We issued the sell signal in mid-June, right around the $260 mark. And then look what happened. This was dead money for about 5 months. Okay. And then we had a webinar last month, and I showed this example as well. And I told, viewers of the webinar, we can get long again on a close above, 290 or so. So if you were a returning viewer, you have a little bit of gain. We lost some ground this past week, but I would probably sell out of that position now if you did buy, based off what we said in the last webinar, because I don't like what we're seeing here. We have, some significant bearish divergence in price from the RSI indicator. And then we have a case of what's called a breakaway gap. So look how prices, there's a price gap here. We opened significantly lower from where we closed the previous day on Thursday. Friday was a gap down, and then we closed out near the lows of the day. So that is not bullish price action, and a pretty strong indicator that momentum seems to be shifting away from the bull's favor, at least in the short term. So that's another example of a bull flag. And again, this was Spotify and a daily chart. Okay, this is another example of a bull flag. This is Calyx Networks. Okay, so there's a couple price patterns here, and we can review them just for knowledge sake. So, back here we have a saucer pattern. This is a weekly chart of Calyx. So again, the bigger the base, the higher the space. That's another thing I want you to take away. When you can identify a price pattern on a weekly chart, okay, it's usually more powerful than identifying a price pattern on a daily chart. So we identified a multi-month, or actually over a year long saucer pattern whereby, we have again instances of prices being rejected by resistance 1, 2, 3 times. And then we have that parabola shaped, U-shaped bottom portion of the pattern. So we did not issue a buy alert on this stock of, upon the closure above the upper horizontal trend line of the saucer pattern, but I'm just showing this, for educational sake. And then, so we broke out, and then what we have here is an example of an ascending price channel. Okay, so that's bullish too, and they tend to behave similar to a bull flag, but again, that was not, the stock was not on our radar at the time. And then we had a bull flag that emerged from this ascending price channel. So again, volatility was kind of compressing for a couple months there, and then we emerged from this pattern. Now, take a look here. This is a descending price channel. When prices flag via a bull flag pattern, they don't have to be horizontal. They can consolidate or flag in the form of a descending price channel, which is basically when prices are trading, in between a range of 2 lower sloping or downward sloping trend lines. So we issued a buy alert on Calyx Networks back around the $18 mark, and we ripped out higher nicely. We've held on to this one for a few months, and we actually just issued a sell signal for subscribers this past week. So we got out last Monday on this one, came away with like a 55% gain, give or take, in about what was that? That'd be like 3 to 4 months. So again, not bad. But what I'm seeing here is some bearish divergence. That's not always grounds to sell. But one of the reasons why I'm closing out quite a few of my long positions is not really liking the short-term price action of this equity market right now. We're seeing, as I mentioned, quite a few instances where, the weight of the evidence is starting to point toward we're entering a risk-off period. Namely, we're starting to see T-notes catch a bid, or interest rates start to drop a little bit. They rallied to their highest level in months recently, but the dollar looks like it might catch a bid too. So these are some of the intermarket types of analysis we use to make general observations on the market. Nothing happens in a vacuum in the market. So what's going on in the bond market or the forex market is going to affect, to a large extent, what's happening in the stock market, and so on and so forth. And the same can be said for commodity markets. So again, this is the principle of interconnectivity, the notion that nothing happens in a vacuum. So again, this was an example of a bull flag on a weekly chart of Calyx Networks. We just exited that position last week. Okay, so let's move on. We'll look at an ascending triangle pattern. This is a weekly chart of Fate Therapeutics. This is a biotech company, one of my favorite sectors right now. And speaking of, biotech and, how it's categorized, we see a lot of biotech companies that are in the NASDAQ. And I think they're going to have to do a lot of the heavy lifting for that index going forward. So not only are we starting to see signs that a multi-year trend of growth stocks outperforming value stocks looks like it's starting to unwind, but even some of the tech stocks, I think some of the FANG stocks are vulnerable, some of the internet stocks, and that doesn't make me bearish in the NASDAQ per se, because it's a really big and inclusive index. But I'm going to be expecting to see sectors like biotech start to do some more of the heavy lifting for that index. So in any case, this is an ascending triangle price pattern. Once again, we have an upper horizontal trend line representative of resistance, And we see that prices were rejected 1, 2, 3 times before we finally resolved higher. The second part of the ascending triangle is the upward sloping trend line. And we see that prices touched this upward sloping trend line 1, 2, arguably 3 times, but we issued a buy alert for subscribers back in September, October on a close above the upper horizontal trend line. And we came away with a, what is that? About a 40 to 50% gain on this one in that range. And this is one of those things you can't cry over spilt milk. So we exited our long positions. I believe it was on a Friday, or in any case, it was the previous week. And then I remember this vividly. We ended up gapping up and ripped higher the following week. So again, I'm not going to be upset about a 40 to 50% gain, but it would have been nice to have 100% gain instead. So I still like the stock. It's just that there's not really a favorable risk reward entry point at this current level. And so I've been talking a lot about risk management and stuff like that. And one of the rules that I like to use, especially when I'm trading equities, it's a little bit different when I trade futures, but we're talking about stocks here, is I like to cut all my losses within the 7 to 8% threshold. Now I mentioned I trade at the end of the day. So I do not use hard stop losses either, because there's an entity called a market maker that loves to drive down the price of a security and stop out those with good to cancel stop loss orders. I'm not going to get into that too much here today, but I would encourage you to do some more research on the role of a market maker in not just stocks, but in markets overall. And so I use price alerts, and if I make an entry on a position, I'll place a stop loss or a price alert about 7 to 8% beneath my entry point. And I'm only going to sell if we are below that stop loss at the end of the day. I don't have an example of this here today, but there were a couple instances last year, especially on one trade, Advanced Micro Devices. The stock was trading below our stop loss during the day, but then we rallied before the day end and closed above it. And then we ended up coming away with like a 50% gain in a matter of 2 weeks. So again, the market likes to play tricks. It's not here to make it easy on you. So again, this is why we need to have principles. We need to have a solid framework to approach an entity that is inherently mutable and constantly trading, that entity being financial markets. So again, this was an example of an ascending triangle on Fate Therapeutics, the weekly chart. We got out a little bit early, but still came away with a nice gain nonetheless. All right, here's another example of an ascending triangle. This is Chemocentrics. This is a weekly chart. This is another biotech company focused on, as you can tell by its name, treatment of cancer and various other diseases. And so we actually are currently long this stock. We put on alert early on, but the chart pattern is kind of morphed. Previously, we had a symmetrical triangle. So the only difference with a symmetrical triangle is, it's not an upper horizontal trend line. It's a downward sloping upward trend line. So it kind of looks like a greater than sign, like from math class back in the day. But sometimes price patterns morph, and this is what turned out. So, I want to give you a trade idea right here. And this is a weekly chart. So if we can close above, let's say the $65, $66 mark on Chemocentrics, that's a breakout. So this stock's looking very promising, and I like it. Like I said, I'm anticipating biotech to do some of the heavy lifting for the NASDAQ in the foreseeable future. So again, once you get in, place a stop loss within 7 to 8% of your entry point. You have to manage risk. So this is another one we like. Neil, did you want to mention something?
Yeah, I'm popping back in. Hey, so this is the most people we've ever had on a webinar session. So I just want to let chat and YouTube and everyone know I'm doing the best I can to get answers for you. But we got to prioritize the questions by what makes the most sense to answer, as in what pertains most to what Gianni is saying, so that you don't lose track. So I'm gonna pause the session right now so that we can answer just a couple of those. So a couple people ask you. This is coming from Lewis, and sorry if it's Louis. I'm sorry if I'm pronouncing it incorrectly. These are about indicators. Gianni, how do you factor in RSI into your analysis?
I would consider momentum indicators as a secondary or tertiary level of importance. The number one thing that I want to see is a price pattern, because price is the ultimate indicator. A momentum indicator is not going to pay you. It's not going to give you gains on the stock. Price is the only thing that pays. So I'm going to prioritize, the observation of a price pattern above all other factors that I might use to determine whether or not I want to be long or short a stock.
Okay. So I'm gonna. I think you answered basically all of them. But I guess what I'm looking for is what do these things mean to you? Because I think a lot of folks that are in here right now, they see. I think they're getting the general idea from this lesson that these patterns exist. They're looking for pennants and flags.
Right.
But wondering, they see these on your screen. For example, volume. When you're looking at volume, what is that telling you? What are you deriving from looking at those green and red bars?
Sure. So volume, I'm looking for signs of accumulation if I'm trying to get long, right? So in order for a stock to rise, there has to be more buyers than sellers. And when we start to see volume trend up, it's a sign that institutions are starting to pour money into the stock. So I mentioned that, institutions really are the only ones that have the buying power to move the price of a security. So if you see an uptick in volume, as prices are consolidating, it means that there's some big money starting to pour in. And then usually once we break out, you start to see a real expansion in volume. And again, that's further sign that the institutions are dumping money. So it all of these factors play a role into the ultimate decision making. But in terms of importance, price is the number one level of importance. So I would put volume, for the purpose of selecting breakout stocks, probably your second or third on the list, interchangeable with, the RSI and another principle that we're going to talk about in just a few slides, which is relative strength.
Okay, great. So guys is gonna he's gonna talk about some more indicators, the
Yeah,
relative strength in this case. So we'll do that, and then we're also getting a lot of people that are kind of jumping the gun and want to become subscribers. So everyone that's watching, if you've already gone to the website to become a Benzinga Breakout subscriber to get Gianni's picks, with all of his research, it goes beyond just the charts. He provides a write up on everything. If you've already gone there and you have questions, I'm going to try to clear those up for you. But for right now, we want to focus on, how these patterns work and how you can make money with them. So, if you have questions, put them in chat and I'll try to answer them. But know that I'll get on video a little bit later and we'll go into, how the packaging works and how you can get into that subscription. All right. That's enough for me, Gianni. I'll let you keep going.
great, Neil. Thank you. Okay, so see, you just had to wait one more slide. Where do we start? How do we find these stocks? So there are two ways to approach the market and to filter the thousands, tens of thousands, possibly even hundreds of thousands of stocks out there. So you can start with a bottom-up approach and just look at thousands of charts a week and try to find themes. Are we seeing strength from biotech stocks or consumer staple stocks or energy stocks? And I know some successful traders that do that. I mean, I personally look at over 1,000 charts a week, but I like to actually take a different approach and start from the top down. So I want to look at broader trends and narrow down those broader trends into more minute themes. Because remember how I said earlier, the longer the trend, the more powerful it is. The trend is your friend until the trend ends, right? Okay, so let's talk a little bit more about a top-down approach to market. So we'll start with the four main asset classes, and there might even be five now with crypto, but you can arguably include that in the currency bucket. So there are four main asset classes to watch. We want to look at currencies. Okay, the U.S. dollar is the reserve currency of the world. We want to look at the bond market. Okay, so the biggest, I kind of rank these in order of size. The currency market's the biggest market in the world. There's trillions of dollars that change hands daily. In the Forex market, you have the central banks directly involved. They have infinite pockets, more or less. Then you have the bond market. Bonds are kind of boring, but they're really important. And that's one of the things I learned when I was in the financial industry. The bond market's a lot bigger than the stock market, and it's where a lot of the institutional money and smart money plays, because, especially when you're talking about pension funds, they have investment mandates. They have to invest money in bonds for guaranteed investments. We'll see how that plays out as we enter like the 40th year of the secular bull market and bonds. We'll see. And then we have, stock market and the commodity market, right? So we use interest rates and currencies to determine which countries are the best to invest in. But that's a little bit beyond the scope of our discussion today. So we're just going to assume that we're all trading the U.S. markets. I know, we saw people in the chat from, different places around the world, and that's great. But, at the end of the day, the U.S. market is the largest and most liquid in the world. So probably one of the better ones to trade in any case. But so if we're just assuming that we're trading U.S. markets, we want to find the strongest performing sectors within the U.S. market. So some of those in recent years have been the tech sector, obviously, communication, biotech, consumer discretionary. Okay, so what are some of the stocks that are included in those sectors? You have the FANG ones, obviously Tesla. I would call it more of a tech stock than an automobile company, but a consumer discretionary nonetheless. Automobiles fall into the category of consumer discretion. Then we have Amazon. That's arguably a consumer discretion, but it's become so big, I'd probably just consider that a tech stock. Apple, things like that. So those have been the large or the main drivers behind the secular bull market in stocks. Now, when I say the word secular, okay, these are trends that have been going on for decades, right? So we have a secular bull market in bonds. So that means that interest rates, they actually peaked in 1981, and they've been declining generally ever since. That's a 40-year trend. Stocks, we kind of had a dead decade of stocks between 2000 and 2010, where they really didn't do anything. I mean, if you look back, the top that preceded the financial crisis in equities back in 2007 was basically a double top to the dot-com bubble that occurred in 1999 to 2000. So there was a dead decade in stocks, but now equities have been ripping higher for over 10 years now. So that's a secular bull market. You make a case that we're in a secular bear market in the U.S. dollar. The U.S. dollar peaked back in 1980 and has been pretty much falling ever since. But I digress. The point that I want you to take away from this slide is relative strength. The most reliable way to outperform the benchmarks is to belong the strongest stocks within the strongest sectors. And this is what relative strength is. So when it comes to relative strength, a stock that displays good relative strength is one that rallies more than the benchmarks when stocks are rising, and one that falls less than the benchmark when the indexes are falling. So that is the key takeaway with respect to relative strength. Okay, so I want you to take good notes on this slide right here, because this is a great way. We're going to introduce you to ratio analysis on the next slide. But these are the 11 SPDR ETFs, SPDR, we call it SPDR in the financial world. And these cover the broad or general sectors that comprise the equity market overall. So I'm going to read these out. I would recommend, screenshotting this or, getting a pen and paper and writing these down as I go through them. So we have the XLC, Communication Services ETF, XLY, Consumer Discretionary ETF, XLP, Consumer Staples ETF, XLE, Energy ETF. This is conventional energy, however, doesn't really include, the green stuff. XLF, financials, traditional financials, not crypto, banks, more or less. XLV, healthcare. XLI, industrials. XLB, materials. XLRE, real estate. XLK, technology, and XLU, utilities. So again, take note of these. You can find them easily online, but sometimes when you look things up on your search engine, what you're looking for doesn't show up at the top of the results. It's just the world we live in now. Okay, so welcome to the world of ratio analysis. Okay, so what we're showing here is the ratio between the technology sector against the S&P. So I do this type of analysis on stockcharts.com. Okay, you can do this in other ones too, but I use stock charts just for convenience sake. I'm not, compensated by them or any way, shape, or form. I've just been using them for years, and I find them to be, fairly user friendly. But so the way that we do this, I like to change it away from the candlesticks. I don't use candlesticks for this because you get a little bit too much information. Sometimes it's better to keep it simple, stupid, right? So we take the one security, in this case XLK, put a colon in between it, and I just put SPY. You could put SPX, which is the actual index itself, but I like to keep it, within the same market, in this case being the ETF. So these are two ETFs. And what we see here is that this ratio is rising. So this means that technology is outperforming the S&P 500 or the SPY ETF on a relative basis. So as this ratio rises, it tells us that technology is doing one of two things. It's either rising faster than SPY or it's falling less than SPY. And it's important to differentiate that. When this ratio is falling, it does not mean that XLK or the technology ETF is falling. It means that the SPY ETF is either rising faster than XLK or falling less than XLK. So look at how far back this trend goes to. This goes back to like 2016. This has been one of the biggest trends under the hood of the market, the absolute dominance of tech, relatively speaking, to the other, or in this case, the broader market. And you can do this across, a variety of different sectors. So if you want to put XLK versus, XLU, if you want to look at the ratio between technology and utilities, you're going to see technology outperforming. But this is the type of analysis that helps you differentiate where you want to allocate your money in the market. Again, the best way to achieve outperformance is to focus your buying efforts on the strongest stocks within the strongest sectors. Okay. The good news about ratio analysis is that chart patterns still apply. So this ratio is the ratio between biotech and S&P. Okay, so here we can see, a case of a double bottom at the bottom. The ratio retested its low back in late 2019. It retested its levels that it was trading down at in, would that be May 2016? What do we see here? We see a case of a saucer or perhaps even a rounding bottom. It's generally the same in terms of observation, but the nuance is that a saucer is more of a continuation pattern, whereas a rounding bottom is a reversal pattern. But once again, we started to see signs that biotech was going to start to outperform the S&P as the ratio continually made new lows, but the RSI indicator was not. So this was a sign that the trend of the S&P outperforming biotech was starting to lose steam. Once we started to see higher highs and higher low manifest in this ratio, it was a sign that, this is a new trend emerging. And now it's really started to pick up steam. Look at this significant higher low that we achieved back in September. And, we've identified this a lot sooner than, this chart might lead you to believe. But like I said, I'm really expecting biotech to be a heavy lifter for stocks going forward. Neil, do you have something to say? You're muted.
Hey, sorry about that.
Yeah.
So we're getting a lot of questions about how to subscribe. So would you mind if I just show folks how to subscribe really quick, and then we'll go back to your session?
Please do.
All right. Yeah, Raj, I'm going to help you right now.
Do you want me to stop sharing, Neil, real quick?
Yeah, and then I'll just share the page. So guys, I'm just gonna buy it with the Benzinga corporate card.
No refunds.
Yeah, no reason to use my own money on it. I already get it for free because I work at Benzinga. Can you guys see the checkout right now? Benzinga Breakout. Can you see it, Gianni?
It says you started screen sharing, but I don't see it.
Okay. It looks like it's pause, resume share. How about now?
Yes, I see it now.
Okay, cool. So guys, this subscription is broken into 3 tiers. There's a first tier, a second tier, and a third tier. We want you to start off in order so that you don't get too many trades at a time, because we don't want you to get confused and make mistakes. So we start off with, it's basically beginner, intermediate, advanced in terms of the frequency of trade ideas that you're getting from Gianni. So to start off, we start off with just this page, which is linked. If you're on YouTube, you should be able to see the link very easily. If you're in Zoom, I'll drop the link in chat in just a second, but I want to show you this checkout process and how it works, because it can be a little bit confusing. So first and foremost, normally this is $197, but we knock $100 off. But today for this webinar, we're also knocking 30% off of each tier of the whole package as you go through this for life. And these are annual prices. So this gets you down to $67.90 a year. And with that coupon code ready to break out already applied. So I'm just going to go ahead and use, I'll use my, I'll do a dummy email address, 23@benzinga.com. This should work. So we're gonna go ahead and make a purchase here. And hopefully this works. It might give me some guff because I'm already in the system. Well, we'll see. Okay, it's working properly. All right, guys. So this is where after you get the first tier, you can stop. If you just want the one easy pick a month, that's fine. And that will get you really far. This is where we're talking about day to week long swing trades. Very accessible. The whole thing here is that this is accessible with quality research that you'll understand and you'll also learn from along the way. So just like this webinar is condensing a bunch of education, you're going to get educations on why Gianni is picking, what he's picking, every time he gives you an update on the membership website that you'll get access to and via email. Now we're on tier 2. So now this is where we're going to add one trade a week on top of the trade that we're already getting. All right. So right now we're adding a weekly trade to our subscription. And all you have to do here is discounted from $297 to $207.90 for life. And that's a yearly subscription, not a monthly. Most places, this is the monthly cost. All right, so we're going to go ahead and just click that, and it's going to add it to my order. Hopefully it works. Once again, you can see that I'm kind of logged into the website because I work at Benzinga, and it looks like it worked. And then the last thing is the third tier. This is the elite subscription. This is where you're going to get multiple trades per week on top of the trades that you're already getting, following all of the strategy parameters and rule sets with tight stop losses. Gianni, what is your typical stop loss on a trade?
I usually place them within 7 to 8% of the buy point.
Exactly. So when we're talking about this, Gianni basically made me feel a lot more comfortable about stocks that I don't know much about fundamentally, because it's okay to have this rule where it's about 7 to 8% being the most that you can risk. All right, so you're going in 7 to 8% stop loss when you're entering a trade, and you're shooting for a pretty aggressive breakout from that. Right. So that should answer a lot of your questions, guys, about wins and losses and stuff like that. Sometimes you might get stopped out of a trade, but then the breakout will still happen. Like that's happened, right, Gianni? Like you get stopped out and then it still goes back up.
Yeah, and sometimes when I issue an update, I'll say buy this back again, and don't worry about wash sales if you're new to trading. That should be the least of your worries. Worry about making some coin versus getting a tax deduction.
That's what I like to hear. And guys, so finally to complete this is normally 547 per year for elite. This is for the multiple trades per week on top of what you've already got. I'm just going to click this and it's going to add it to my order. And then now with this new email account that I'll have to do some form of refund with, I will now have access to Gianni's membership site, and I'll be getting email alerts. And then very soon, Gianni, you and I got to talk about this a little bit, but very soon, SMS or text message alerts. So the second that Gianni is making a trade, you're going to get a text with exactly what you need to know, and then a link to go to the membership site so that you can see a little bit more about his research and his thinking going into it. So guys, that hopefully that answers most of your questions. I know that we're going a little over on time on this, but there was a lot of it in chat. I just wanted to address it. So now I'm going to shut up. I'm going to get back to the education. Gianni, you can share your screen again, and guys, I'll drop the link in chat. All right, thanks.
Sweet. All right, oops, here we go. Get back to how to spot emerging trends. Okay, so what we're looking at now is, I like the ticker symbol of this ETF, PB&J, okay? So ratio analysis can help us spot emerging trends in the market, right? And we kind of looked at that example in the previous slide in biotech, how we had a hunch that it was going to start to turn and start to outperform. So this PBJ ETF is a food and beverage ETF, and we can see here that the ratio looks like it might be bottoming, which means that food and beverage stocks could be on the precipice of outperforming relative to the S&P. Now look at this bullish divergence that we're seeing in RSI, and we observe a falling wedge pattern. Okay, so a falling wedge is, basically an indication that volatility is contracting in the trend and poised to reverse. So, I mentioned I trade futures, and not a lot of people talk about this stuff, but I'll just give you an example of why I think food and beverage related stocks are probably going to have a nice run here. We've seen like the price of corn almost double since August. We've seen, various agricultural commodities like soybeans, wheat, corn, oats close out at their highest, weekly levels in like 6 or 7 years, just in like last month or so. And higher closing highs are indicative of bull trends. So this, makes a case for, increasing inflation and, unfortunately, probably a higher cost of living going forward. So, that's why it's good you're trying to get involved in markets, because, we all need to make money. And that's one of my things, one of my themes with this service is transparency, education. And I want us all to make money together. I'm not trying to, keep any secrets from you. I tell you the criteria that I use to select trades, and not every trade is profitable, but it doesn't have to be. I told you at the beginning, we can afford to be right 1 out of 4 times or have a 25% trading accuracy and still be profitable so long as we manage risk properly. The good news is that we're profitable. Our trade profitability is much higher than 25%. So, do the math at that point. Okay, so let's talk about how this enables us to look at nuance within the sector. So, the food and beverage sector is traditionally a defensively oriented sector. So if we start to see that sector outperform, it's a sign that the bull market in equities, could be poised for a high. And I still think that's the case, but this ratio is the consumer staples ETF relative to the S&P. And we have a rounding top or an inverted saucer pattern on this ratio, which suggests that the consumer staples ETF is probably poised to continue its underperformance relative to the S&P going forward. Now, that would be, we would change our outlook on this if we could get back above this lower horizontal trend line. But again, I wanted to show you an example of nuance. So we have subsectors within the consumer staples, the defensive oriented sector, starting to perk up, but the generally defensive sector of consumer staples still outperforming relative to the S&P. This helps me discern that any pullbacks in the equity market would likely be corrective in nature versus an actual reversal in trend. And that's important to differentiate. You don't want to get shook out of your core long equity positions on a correction. Okay, a correction is always going to happen, but an actual reversal in trend, if we enter a bear market, that's a different story. So a couple other things I mentioned, we want to look for signs of accumulation. Let me move my icon here. Okay, so trading volume represents the number of shares traded within a given time frame. So if we're looking at a weekly chart, we're looking at weekly bars, weekly volume bars. That's the amount of shares traded in a week. The same holds true for the daily chart. More buyers means rising prices. More sellers mean falling prices, okay? And if we're buying breakouts, we want to see more buyers and sellers, but short squeezes are our friends too, okay? So when you short a stock, you're actually borrowing the stock with the intention of buying it back from the person you borrowed it from at a lower price. That might not sound very intuitive, but if it's not, look it up and do a little more research on it. So basically what happens when you see a short squeeze, you usually see a break higher. And one of the ways that I use, one of the things that I use to see if significant accumulation is taking place, and you might have noticed that on some of the charts early on in the presentation, but I have a little red line that is overlaid the volume bars. And when I start to see, the 20-week or the 20-day exponential moving average of volume exceeded, that's a sign that significant accumulation is starting to take place. And And yeah, again, we want, if we're going long, we want to see more buyers and sellers. And this is a great way to see if statistically significant accumulation is starting to take hold on a particular stock. Okay, so we're coming around the corner now. How do we actually time a breakout? Okay, you heard me mention before, time is not money. Time is precious. Time is finite. In this fiat monetary system we have, money is infinite. Okay, so this is a mindset thing too. Time is more important than money. An improperly timed purchase of a breakout can damage your risk reward ratio. That's why I said that I want to trade at the end of the day. Closing prices matter the most, because if a stock trades above my buy point but closes below it before the end of the day, that can turn into a case of a false breakout or a whipsaw scenario, and you can get stopped out earlier than you would like. And the same holds true for a stop loss. If a stock trades below your stop loss during the day, there are times where it reverses and closes above it, and that ends up being the low. And you don't want to get shook out because of some games or gimmicks that a market maker is playing with the price of a stock. So let's talk about definitions, because definitions are so important. If we do not have the same definitions for the same words or phrases, then we're not speaking the same language. And I think, one of the things we're seeing, not just in the United States, but around the world, is we're having, instances where people that speak the same language no longer understand each other. And that's a big problem. So we need to make sure that, when we are saying things like an upside breakout, what does that mean? What is the definition of an upside breakout? An upside breakout occurs when a market or a stock closes at a new high above a level of resistance or above the previous highest closing high. And I'll show you what that means on the next slide. A downside breakout occurs when a market or a stock closes at a new low underneath a level of support or below the previous lowest closing low. And so it's important to differentiate, because we can see different breakout price points for different time frames. So, a breakout on a daily chart might not mean a breakout in a weekly chart. But you remember how I said the longer term trend tends to overpower the short term one. So if you see a breakout on a weekly chart, chances are it's happening on a daily chart. I really can't think of an instance where that wouldn't be the case. So that's a good principle to hold, close to your mind, is that, if you're starting to see a breakout in a weekly level, it's probably going to be a bigger breakout, in terms of potential returns than a breakout on a daily level. So let's look at an example of Ethereum. Who doesn't love crypto? Drop a one in the chat if you trade crypto or own some. I actually don't own any coins directly. I own some of the trusts, but we made some pretty coin on some of the cryptocurrency miners. Stuff like Riot Blockchain, Marathon Patent Group. Those were some big winners last year. I want you guys to know. I mentioned I've been trading about 9 years, and last year was the most incredible market I've ever seen. It's not always like that. I remember when I was still working in the advisory world, it was about 2 years, the market pretty much did nothing or traded within a 15% range. Now, that's where the type of factors that we look at become more important, because there's always a bull market somewhere. Just because the equity indices might not be moving doesn't mean there's not stocks moving under the hood. So you just have to know how to, look for them and screen them and find them. So let's talk about how we actually come up with a number to provide a breakout point. So first things first, we have to identify a tradable price pattern. Let's go back to June 2020. We observed an ascending triangle price pattern in Ethereum, once again characterized by an upper horizontal trend line representative of resistance, and then an upward sloping lower trend line. That's the lower part of the pattern. So what do we do next is we look inside the price pattern and we ask ourselves, what is the highest closing price that we observe within this consolidation or within the price pattern? So the highest close that we observed in this ascending triangle was $248.44. So I told you I like to keep things simple, KISS, right? So we can issue a buy alert on a close above 250. Okay, so as soon as Ethereum closed above 250, I think I ended up closing like at 255. Big deal. You missed, it by $5. But all the more reason to trade at the end of the day. And we ripped higher, okay? So then we started to consolidate again. Again, what do we see here? Volatility expanded and then it contracted. Ethereum was range bound for about 3 months between August and November. During that time, we noticed that prices consolidated and morphed into a saucer pattern. Once again, evidenced by an upper horizontal trend line representative of resistance, and then a lower U-shaped parabola portion of the pattern that is the secondary part. So what do? We look in this price pattern within this consolidation, and we observe the highest closing price of this consolidation was at $275.99. So we can say, again, to keep things simple, that we can buy on a close above 476, and that was achieved on November 12th. And let's see, Ethereum prices were around like 475 at that time, and you pretty much tripled your money. And what would that be? 2 months, 3 months? Not bad risk reward. If you just would have set a 7% stop loss, you would have been managing risk like a pro. So I do some crypto research, and I have those services. We actually, it doesn't always happen like this, but we issued a sell signal when Ethereum reached 1350, and that was actually the high. The high was 1350.01. So again, that doesn't happen. I don't even have the intention of selling the high, but there was a reason why I selected that, and it was basically a double top, a retest of the former all-time high of Ethereum going back to December, or it was actually January 2019. So, look what happened. This is a daily chart of Ethereum. Hit our price objective of 1350. We sold, or basically reduced, because I still think crypto is going higher, in the longer run. Short term, I think we'll see some congestion. It would actually be healthier from a technical standpoint to see some consolidation after an impressive run like we just witnessed. And so I mean, look what's happened. I mean, it's been dead money for a couple of weeks now, but we reduced our position, and I still like it. If we look at, we're not going to look at a weekly or a monthly chart of Ethereum, but I mean, I wouldn't be surprised to see this go to 2,500, $3,000 per coin at some point. So that actually wraps me up for the educational content that I wanted to share with you today. So what I have on the screen now is kind of a rehash of what Neil said. So the initial service for the breakout opportunity letter, the monthly pick, we issue the alert within 7 days of the month. Neil showed you how to make that purchase, which is great, Neil. We appreciate that. And I give you the stock, give you the ticker, give you the rationale behind that. Neil showed you how to upgrade the subscription if you want weekly picks or 3 times per week picks. And we use the 3 delta factors, and we share those 3 delta factors via our breakout opportunity letter and the breakout trade alert. And then when you subscribe to the elite series, which is the tier 3 product, or do we call that tier 1, Neil?
Wait, what was the question? I'm starting to get confused now.
No, what do we call the breakout elite? The 3 times, is that tier 1 or is that tier 3? Do we
That would be 3, so it goes higher. Yeah,
okay,
elite
so
is tier 3.
That's the tier 3 service, and I actually share the 5 alpha factors. So, my 3 delta factors we cover in the first 2 levels of the service, and then the 5 alpha factors I share a little bit more information, and there's a method to the madness. Mm-hmm. And the most important thing is, I actually don't like being called an expert, because that has connotations that, I've arrived and I don't need to learn anymore. I like to be considered forever a student of the market. If you do not humble yourself before the market will humble you. And I promise you that, because it's happened to me. It happened to me quite a bit, especially in my early days of trading, until I developed a set of principles, until I incorporated the 3 delta trade factors and the 5 alpha factors into my method of analysis. That is where I really was able to turn a corner. So there are multiple free online resources to continue your research. Benzinga puts out some of the best financial content out there. I really like their stuff. Stockcharts.com has some free information, Investopedia, TradingView. There's plenty of free resources on there, or out there, to expand your knowledge. In terms of books, there are some fantastic books written on technical analysis. Probably the best one I've ever read is Technical Analysis of, I'm looking at my bookshelf right now. Technical Analysis of Stock Trends by Edwards and McGee. You can find that on Amazon. That is what many consider to be the Bible of technical analysis. Then you have Technical Analysis of Financial Markets by John Murphy, Intermarket Analysis by John Murphy. You have How to Make Money in Stocks by William J. O'Neill. And then you have the ultimate book on stock market timing, volume 1 through 5, from my good friend and mentor, Raymond Merriman. That's an exceptional book series too. So, and then obviously, one of my goals with the Benzinga Breakout series is to educate you as we're making money. So it gives you a unique opportunity to earn while you learn. This service is not like traditional education in the sense where you put up a bunch of money up front, and you have to put time in, and it might take years to see a return on investment. I want you to make money while you are learning. So earn while you learn. And that is what is so unique and special about the service that we provide here at Benzinga. So that is all I had for today. Neil, do you have anything else to share with viewers?
Yeah, thanks, Gianni. I just want to echo what Gianni was saying and thank everyone for joining us. This is, this has been an educational session. This is just a sliver or a tiny piece of the puzzle that you get when you're a subscriber. If there are some breakout subscribers on the webinar right now, you already know that. The books, I'll do the best I can to get them in there. I think the first one, which one did you say was like the best one for technical analysis, Gianni? The best book?
Technical Analysis of Stock Trends. And that one's so fascinating because it was written in the early 20th century. And the price patterns they identify in that book, they've been happening for hundreds of years. So human behavior has really not changed, in hundreds of years, thousands of years. It's always been the same.
So now I think, guys, let's talk about the subscription specifically, and then we'll wrap it up, guys, because we're over time. But I do see that we're getting a lot of questions about how the subscription works. So I'm gonna share my screen. I got to open the chat window back up really quick. Let's see. Okay. Let's get a screen share going. And then, guys, if you have specific questions about how it works, drop them in the chat. I have a general idea of what the outstanding questions are, and I'll try to answer those as I go. So just be patient with me. Gianni, are you able to see the checkout page? Am I sharing it? Okay. So let me get chat back open. It changes every time you shift your role. Q&A, chats. Okay, guys. Yeah, do you get a copy of the recording? Yes. You guys can find this on the Benzinga YouTube channel. You can also, if you guys registered for this session, you'll get a recording in your inbox by email. So guys, these tiers, they're named. It's tier number 1 is 1 stock pick a month to keep it simple. This is the KISS method. Keep it simple, stupid. Don't overwhelm yourself. We are shooting for the fences though. We're swinging for the fences. So we're getting 1 great trade a month, shooting for that like 10, 20, 30, 40 double-digit percentage returns. That's the whole point of breakout stocks. All right. So you're getting the education, you're getting the chart analysis, you're getting the why and the how with each one of these trades. But you're keeping it simple. This is perfect for beginners. That's how Gianni and the rest of the Benzinga Breakout team designed it. All right. So to get to that, you should be using the link that I've put in chat. You should be using the link that I've tagged in YouTube or pinned to the YouTube chat. And then you're gonna enter your email address. So I'll just do a new one here. And the coupon code ready to break out should already be applied. These tiers, these different subscriptions, at each level you get more of Gianni's strategy. It gets a bit more complex, and you also get more trade ideas. All right. And how do they fit together? They stack on top of each other. They stack on top of each other. Noberto, what does Benzinga mean in all caps? Question mark. It doesn't mean anything. That's what's great about it.
Benzinga.
It's just a made up word. Guys, Guys, and if you're getting the error 500, I apologize. Please email newsletters@benzinga.com and we'll get you taken care of. Most people shouldn't be getting that right now because it's working for me. So just going through the purchase process, yes, these stack on top of each other. So right now I'm getting 30% off my annual payment for life. Tier 3 is not just more stocks. It's a lot more information and education and insight into the trading strategy that Gianni is using at that more frequent trading level, where he's using his 5 alpha factors. Does that sound right, Gianni?
That's correct.
Yeah, I should know by now. All right, so we're going to go ahead and we're going to make this first purchase. So this first purchase, $67.90 for every year for life. That's it. If you want to cancel, you can cancel and get a refund. You can cancel within the first 14 days for any of these tiers. No problem. We'll cancel your subscription, give you a full refund, no problem, no questions asked. I just highly recommend that you get at least tier 1 and tier 2 so that you can get enough trades so that you can try them out, so that you feel like, so you can check them out and see if it works for you. And then if you don't like them, no questions asked, money back guarantee. All right, and then we add to our order for $207.90 a year. You lock in that 30% discount. If you have any issues, guys, if you guys are having any issues now in the future, if you're becoming a subscriber, you can always email newsletters@benzinga.com. That's how you get in touch with our customer success team, and they'll take care of any problem that you have. So far, I have purchased my 1 breakout opportunity. I've purchased my 4 alerts, which is 1 alert per week per month. That's coming pretty much every Sunday. And then sometimes if the market's not giving Gianni something that's great, it might be a Monday or Tuesday, but it's pretty militantly every Sunday. And then now we're getting to Elite, which is much more frequent trading and a much more detailed explanation and level of research and education that's going into the picks that you're getting. And that is discounted from $547 a year all the way down to $382, basically $383 per year. And that coupon is for life. The discount is for life. All right. So yes, this will expire. I don't know when, but I recommend getting at least 1 and 2 now. And then if you want to pay full price for it later and you want to get more trades, go ahead and get the Elite. It will go back up to 547. Or if you want to try them all now, just get all 3. And it's a no questions asked 14-day money back guarantee. And yes, guys, yes, you'll get updates. Mohammed, you will get updates on previous trades. So if there's anything that has happened, that has changed, that is relevant to you as a subscriber, Gianni will issue an update on previous trades, even if it's a trade from 3 months ago. Gianni will issue an update on it.
Yeah, at the end of all the reports, I have a performance update and review section. So if I issue it, if we're talking tier 2, the weekly pick, I'll list all the active trades. And sometimes, I'll provide a trade and nothing manifests, and I might even tell you to stop watching it. So I will never send you a pick and then just leave you hanging. I will give you updates, and yeah.
Exactly right. So, guys, is there a lifetime membership? For a lifetime membership, IU, email newsletters@benzinga.com and tell them that you're interested in a lifetime membership. We will give you a discount for that. If you guys are interested in getting a lifetime, we'll make sure that will get you a price that makes sense for that, so you can save. So with that, I think it is time that we bring this to a close. So Gianni, thanks so much for spending all this time with us on a Sunday, man.
Thanks, Neil. My pleasure.
All right, and then I'm going to close this out. Maybe we can hear this royalty-free music. I don't know if that's coming through. Is that coming through, Gianni?
Yeah.
Oh, cool. For a lifetime membership, email. I'm putting it in chat. Newsletters, plural, @benzinga.com. You get that lifetime membership. I recommend using the link I provided. I'll drop it in there again. 30% off every level. My computer can't handle the tech now. It's slowing down. And everyone on YouTube, thank you for joining us. Make sure to hit subscribe and hit that bell so you get alerts so you don't miss these surprise lessons, these surprise sessions. Thank you so much for joining us. All right, I'm going to close it out. Thanks, Gianni.
See you, Neil.
All right, everyone have a great day, and I'll see you in the markets. Bye, YouTube. Bye, Zoom. Happy trading, guys.